everyone. I'm Dr. Jessica Woolworth, a practicing CPA and an accounting professor. So, we're going to be talking about adjusted basis. If you sell something, you don't want to pay any more tax on it than you absolutely have to. And one of the important things to do that with is knowing how much what you're selling actually cost you. So, let's take an example of sneakers. If you have a sneaker collection, let's think about that. And let's say you bought some Jordans for $200. But then you had to spend $50 cleaning and restoring them. So what's your basis? The $200 that you paid for them initially, or 200 plus your $50 that you had to spend restoring the Jordans, which would equal $250. So that $250 is what we call an adjusted basis. So adjusted basis is what you have really invested into an asset after the purchase plus improvements, minor things like depreciation. So if you sell those sneakers for $400, your taxable gain is $150. That's the difference between the sales price and your adjusted basis. And remember, your adjusted basis is going to most likely be different than what you initially paid for them in the first place. So let's take another example. What about an apartment building? If you buy an apartment building and you're going to rent it out, you have the initial basis of what you purchased, your purchase price. Then if you have to put on a new roof over that apartment building, that's going to increase your basis too. What about having to put in new concrete for some patios? What about painting? So these different things can adjust your basis. And then depreciation. Remember that we have cost recovery. If you buy an apartment building, you can't just deduct it all in the first year that you purchased it as an expense, because you're going to receive revenues from this apartment building for many years to come. So you have to systematically deduct the cost of that asset over its useful life. And for an apartment building, that's going to be 39 years. So if you purchase that apartment building for $1 million and then spend $100,000 on a re-roofing project and then $30,000 on some concrete, and over the period of time that you've owned the apartment building, there's been $200,000 of depreciation, then your adjusted basis is going to be $930,000. And that, when you sell your apartment building later, you want to use the $930,000 versus the $1 million that you originally purchased your property at. So next time you flip sneakers or make an investment in an apartment building, just remember, your adjusted basis isn't just a sticker price, what you originally purchased it for. It's what you've actually put into them, less your accumulated depreciation.